love to kick off our conversation with a look at today's weekly jobless figures coming in slightly above expectations. 198,000 Americans filing for unemployment. Let's get your reaction to that top line print. What stood out to you?
Well, it's going up slowly, but the thing is that business cycles happen very, very, very slowly, and then all at once around the pivots. And so we just haven't seen the labor market breaking down yet. It is quite a lagging indicator, and I think that that's why it's one of the things that the Fed chose, because it gives them the most flexibility in their narrative as far as being able to remain hawkish for longer, because the labor market will turn on a lagging basis.
And what's your overall sense as to why the labor market still remains as tight as it is?
Well, I do think it's funny, tech is laying a lot of jobs off, and I see these sort of anecdotal things where people they just go get another job. And they get their severance pay and then they just go get another job. So that's the upper 40%. If you bifurcate the economy between the lower 60% and the upper 40%, the lower 60% are living paycheck to paycheck, have less than $500 in savings, and are putting ever increasing grocery costs and other costs on their credit cards. And so you've got a lot of risk in the credit markets just having the majority of the economy in that status. But if you go to the upper 40%, and most of the layoffs are occurring so far in tech, those people they're getting big fat severance packages, and then they're running over and getting new jobs, and they're still consuming a lot. So it's kind of a confusing picture, and that's why it gets a little bit clearer when you start to bifurcate the economy. And then when you start to look at the trajectory of what could occur, you can predict on a different basis what the 60% will do ultimately, what will occur there versus the 40%, and then calculate the impact that 60% will have on the overall global macro economy.